And Anya, feel free to take it over. Yeah.
Great. Thank you, Ayon. Hello, everyone. Thank you very much for joining us for the second installment of the Accounting Design Project. And again, thank you to Ayon and Stephen for organizing the sessions, very interesting seminars. So just a few housekeeping rules before we get started with our presentation. Please unmute your mics when you ask a question. We'd like you to raise your hand using the Zoom function, or you can also ask your question in the chat. I'll be moderating those questions as they come in. Daniel, our presenter today, has asked to have 5 minutes uninterrupted at the beginning and at the end of his presentation, just to get through the paper and through the main points. And again, we encourage you to actively participate to help us better understand the paper and also benefit the authors of the paper. Without any further ado, let me introduce the speaker. This speaker is from the University of Waterloo, that's Daniel Jiang, and he'll be talking to us about loss and standardization, revisiting accounting-based return anomalies using as-filed financial statement data. The floor is yours. Thank you, Daniel.
Thank you, Anya. Hello, everyone. This is Daniel here. I am an assistant professor from School of Accounting and Finance at University of Waterloo. It is really my great pleasure today to present this paper. This is a paper I'm working together with Kai and Steve. So both my co-authors are from my alma mater, Penn State, and they're also attending today's workshop. We are really looking forward to your comments and suggestions so that we could keep improving our paper. So as the junior faculty, just like some of you in today's audience, I noticed there are also some PhD students joining us today. I am to some extent spoiled by the easy access to financial statement data provided by the commercial data vendors, such as the CompuStat. So a lot of times I take it for granted that if I want to use any accounting data in any of my research, CompuStat is my go-to place. However, in her speech at the 2016 AICPA National Conference, then SEC Deputy Chief Accountant Julie Earhart asked a very interesting question. Do you know how the financial information provided by third parties compares with the financial statements that your companies filed with the Commission? Well, we have some anecdotal evidence that third-party data could be different from the original data, and there are market consequences associated with it. For example, Adam Aron, the CEO of AMC Entertainment Holdings, once called out the data providers such as Bloomberg, Capital IQ, and FactSet. We all familiar with those data vendors. Because those vendors mispresent his company's financial data and caused confusions in the stock market because of the data mispresentation. Despite the anecdotal evidence, it was still once considered as a mission impossible to systematically compare the data from data vendors with the company's original data. It was not possible until the SEC's introduction of the XBL format data. The biggest change that XBL brings is that it allows users, including the researchers, to obtain the accounting data directly from SEC. So these data are parsed out by SEC staff directly from public companies' filings, and they could serve as an alternative to the data from the vendors such as the CompuStat. So there's no doubt about the importance of the data to our accounting profession. It is very important to our researchers. It is even more so to the practitioners' decision-making. So if we want to understand what is good accounting and what is bad accounting, which is exactly the mission of the accounting design project, we think understanding our data should be the key step. So with that being said, the research questions we try to answer in the studies are pretty straightforward. First, is there any significant difference between the as-filed data and the CompuStat data? If so, whether the data discrepancies affect the research inference, in particular, the inference from the stock return anomaly studies. The second question is, what caused the difference? Because there are so many different accounting variables that have been documented to predict future stock returns, and we have to choose one as our laboratory or the test bed. The one that we choose in this study is accrual anomaly. On one hand, accrual is a very accounting concept, and on the other hand, for the accrual anomaly, if it is not the most studied, it must be one of the most studied anomalies in the past. So we think the accrual anomaly should be a good starting point for our project. So here is a summary of our findings. We find that during the period between the 2012 and 2018, operating accruals have different values between CompuStat and Xbl data. The data discrepancy is significant and large enough and affects both the existence and the magnitude of the accruals anomaly. In particular, we are unable to document accruals anomaly using CompuStat data, which is not surprising at all, because similar findings have been found in the existing studies. However, when we switch from the CompuStat data to the Xbl data, we find the accruals anomaly is still alive. So what causes difference? Our analysis suggests that it is attributed to the way that CompuStat standardized accounting data, but not the data quality issues associated with the Xbl data. Given the existence of the data discrepancy, does any investment professionals notice it and even use it in their trading decisions? We find hedge fund does. It appears that hedge funds trade on accrued signals extracted from the structured filings. And finally, we find the difference in the return predictability of accounting variables is not limited to operating accruals. So after extending our analysis to another 19 accounting-based anomalies, we find that 4 more anomalies are also affected by the data source. And a common feature among these 5 anomaly variables, including operating accruals, is that these accounting variables involve the line items that are deeply embedded in the financial statement. So before I open the floor for the questions, and before talk about the details about the empirical analysis, I'd like to emphasize a couple of things, a couple of caveats about our study. First, the goal of our study is not throwing shadow on CompuStat. We are not advocating against using data from CompuStat or other data vendors. To be honest, I'm still using CompuStat in a lot of my research. And we are not against the data standardization practice in general either. So what we are concerning in this study is how the data is standardized. So although we know CompuStat has an online manual explaining their practice and what is included or excluded from a specific CompuStat variable, the manual is rather lengthy and not easy to comprehend. And what we want to achieve in this study is to remind people about both the existence and the potential consequences of the data discrepancy between the third-party data and the company's original data. So the bottom line that we want to state in this study is we should understand our data before using it. So with this being said, I'm going to move to my next slide, and also I'm just open to more questions. So, okay, so since no question.
Dan has his hand up, so Dan, please go ahead.
Okay, sure, go ahead, yeah.
Yeah, in order to draw any conclusion from the findings, I think you need to make some assumption here. Either you assume that the market is efficient, and then the question of the paper becomes, okay, what kind of data is used by the market, assuming that it is efficient? So any data that, or set of data that results in the absence of the accrual anomaly would be the set of data that the market uses. Or you assume that something about the database. What is the database, the correct database, right? And you don't make any assumption about efficiency. And you want to see that if you assume that the market is in, you assume that the XBRL is the data, correct data, and then you test whether the market is efficient. So, but without one of these assumptions, right, the results are not interpretable. I mean, you can find, certain sets of data, create certain anomalies, and if you have different set of data, you create different anomalies. Perhaps you can find that certain industries, if you went further into industries, are, the data for these industries, make the market look efficient. Certain data look the market efficient in this industry, but on another industry. I mean, it's bewildering. So I'm just trying to put some structure on what question you ask and what underlying assumptions are being made here.
Mm-hmm. Thank you, Dan. I think it is a good question to discuss the market efficiency. We think about the market efficiency, but our question is, what is the, so when we talk about the market efficiency, what is the foundation? What is the base that the capital market participants trade on? Like based on our studies, even though we do not tabulate any result, we still think most of the capital market participants rely on the data from the data vendors, such as the CompuStat, to make their trade. So from that being said, the market seems to be efficient. At least we are no longer able to document any significant accruals anomaly based on the CompuStat data, because the market participants probably have already arbitraged away the accruals anomaly. But on the other hand, we think the fact that the most of the market participants using the CompuStat data doesn't make it, say, the right data to use, because from our perspective, the Xbl data, they are the data from the filings prepared by the corporate accountant, and the corporate accountant definitely knows the company the best. So we are not trying to argue that the Xbl data is definitely superior than the data from the CompuStat. Like I just mentioned in the previous slides, we want to remind people about the potential data discrepancy between the original data and the data provided by the data vendors. But the straight answer to your questions, we think the most of the capital market participants still use the data from the data vendors. And the low awareness of the Xbl data is definitely one of the constraints to the Xbl data. And we want to show the usefulness of the Xbl data to remind people, okay, so there is a new data source and it could provide you with some trading advantage, which we have shown a little bit in our hedge fund trading analysis that I'm going to discuss later. So,
well, it's not clear to me. You assume that the market is efficient or not efficient, or let the data tell you. And if you let the data tell you, you have to assume which data is being used by the market, right?
Mm-hmm. I mean, if we are talking about the CompuStat data, which most of the capital market participants use, then it seems the market is efficient. But again, my argument, market is efficient based on what data? If we are talking about Xbl data, then I don't think it is that efficient, because it still left some arbitrage opportunities out there for the investors.
So the underlying assumption is that the XBRL data is the one that the market should use, or the market is using?
Not a lot of the market participants are using XBRL data. This is a fact. But we think the market participant at least should consider using the XBRL data, and because it can provide the investors with some advantage. But later I will show you our result about the hedge funds trades, and then we can discuss more about this market efficiency issues.
So the market, but you're saying that the market is inefficient in the choice of the data that they are using, right? So you assume that the market is inefficient? From the
XBL data's perspective, I always want to emphasize from what data perspective. It's just like when we want to arbitrage on something. So what is the foundations for that arbitrage opportunities? Is that foundations? We identify that arbitrage opportunities using XBL data, or we identify that arbitrage opportunities using the CompuStat data. So previously, I mean, in the most of the existing literature, we just discussed the market efficiency from a very general perspective, because most of our research are based on the CompuStat data or the data from other data vendors, then it seems that at least with regards to the accruals anomaly, the market is efficient because we are not able to document any CompuStat-based accruals anomaly. But because of this new data exists, if we switch the data source, we find the market is not that efficient because there are still some arbitrage opportunities with regards to the operating accruals if we use the Xbl data.
So the Xbl data is the data that the market should use.
Well, this should be a question for another study. The Xbl data definitely has its own issues, so we are not arguing Xbl data is a perfect data. So that is why in our very last slides, when it comes to the implication of our research, we are advocating for the regulators to trying to increase the reliability and the usability of Xbl data so that more and more market participants could use the Xbl data. But for now, it is definitely underused then. So that is the fact.
Thank you.
Thank you, Dan.
Thank you. That was an excellent discussion. Why don't we move on? I think Frank has his hand up, but Stephen, did you want to jump in and utilize your authority as the co-author to say something?
I wanted to try to respond to my senior Penn State colleague about this. And I think this market efficiency question is important. The way I think about it is statements about efficiency are made with respect to a certain set of information. And so if you look at the results in this paper, you could say the evidence is consistent with the market being efficient with respect to data that's in CompuStat. If we conditioned on information that's not going to be revealed until the end of next week, we would probably find that the market is inefficient with respect to that information. The thing about the XBRL data, though, is it is available at the time when the trading decisions are made. And I would interpret the evidence as being evidence here through that lens, Dan, of the market being inefficient with respect to data that are in the XBRL filings. And I think that's a useful way of thinking about this.
Thank you, Steve.
All right, why don't we have Frank ask his question and Ayong, and then we'll move on to give Daniel a chance to proceed with the paper.
The accrual anomaly is heavily traded on Wall Street. So another way to interpret your results is that because most institutional investors use CompuStat data, so the accrual anomaly goes away if you use the CompuStat data. It's not to invalidate your paper, simply it's a dynamic process. If one day most institutional investors started to use XBRL data, then the anomaly based on XBRL would be gone as well. Would that be a way to interpret your results?
Yeah, I believe so. I think it is a good way to interpret our results. Yeah.
Thank you, Ayong, please.
Yeah. So I have a question more about like standardization. So like I think you highlight a lot about how CompuStat standardize those financial statement items and then kind of supply to all of us. But doesn't this SE file based on the FASB taxonomy also is another form of standardization? So based on your opinion, kind of like figure C1 is that as an example, or the operating lease examples that you showed us on previous slide, right? Whether a specific business activity is operating or financing really depends on which industry, the business model, and specific firm's nature, right? So like last week, Bob's was talking about heterogeneity in accrual measures in the other accrual item. And then here, I think as archival researchers, we want to run a large data set. So we need somehow standardize it. So I want to hear a little bit more about how does this SE file classifying things or aggregating things differently from CompuStat. So thinking about two aggregation systems and then what are the information attributes differ to help us understand which one is superior to others on the specific situation. So not which one is investors should use, but investor will be aware of the differences in terms of information attribute between these two data sets.
Yeah. Thank you, Ian. I think this is a perfect question. Like, I'm just about going to discuss this standardization issues in my next slides. So standardization is a practice that exists in this data vendoring industry. So it is not unique to CompuStat. Even if we use the XBRL, we still need to standardize the data. It's just like how to standardize the data. So when it comes to the XBRL, so why don't I just briefly talk about the data, and then I'm going to discuss the standardization issue. Okay, so a very brief description about the data we use in our studies. We still rely on the data from the conventional database, including CompuStat, CRIS, FactSet, Thomson Reuters. And when we try to evaluate hedge funds' information acquisition activities, we rely on the data from the Edgar log file. And for the Xbl data, we use the Xbl data prepared by the SEC. So they are publicly available on the SEC website. And to better make sense of the XBRL data, or like in Ayon's words, to standardize the XBRL data, we also use the FOSB reporting taxonomy. So what is this FOSB reporting taxonomy? It provides us with a structure because it clearly defines the hierarchical relations among different XBRL tags. And technically speaking, the reporting taxonomy is the basis to standardize the XBRL data because it classifies the XBRL tags into different levels of depth. So tags at two adjacent levels of depth have a clearly defined parent-child relations. So on my right-hand side of my slides, this is a screenshot from the 2020 version of the FOSB reporting taxonomy. The taxonomy itself is updated annually, and all versions of the taxonomy are also publicly available on FOSB website. And so when the companies file their XBRL filings, they need to indicate which version of the reporting taxonomy they have used. So the screenshot here is about the balance sheet. And as we can see at level 1, the most aggregate level, we have two tags, assets, liabilities, and equity. And for assets, it has two immediate child tags, current assets, non-current asset. They're at level 2. So the larger the level number, the more disaggregated the data is. And because of they have the parent-child relations, it must be the case the value of the immediate child tag should be added up to its parent tag. So in this example, it must be the case current asset plus non-current assets must be equals to the total assets. And for, say, for current asset, it has its own immediate child tag, which are at level 3, cash, receivables, etc., etc. If we want, we can click the plus sign here to figure out the immediate child tag for each level 3 tag. So basically, we can keep expanding this tree structure until we reach to the very disaggregated level of the data. And
now, like I think another way, a more direct way to ask you this question is that, is this a file differentiate from CompuStat is because it provides more disaggregated line items, or because it actually provide more better classification? So thinking about accounts receivable, it can be operating for some kind of firms. It can be financing for other type of firms. So I saw that Doroni is here. Like I think in the past, faculty members at Columbia always have debate over different line items. Some people think pension will be operating for certain industries, can be financing for other type of firms. So does this new SE file actually is better beyond disaggregation, but actually do a better job of classification?
I think you are right on the money. I mean, like more disaggregated data is definitely one of the benefits provided by the XBL data. And I think this must be reporting taxonomy, because this is taxonomy from provided by the regulating body. Therefore, in our opinion, it is more authoritative. It's just like this is the way we should aggregate certain accounting line item together and call it, say, receivables. What should be considered as part of the receivables? So this is a key difference between how XBRL doing the standardization from the standardization practice, say, made by the CompuStat, because CompuStat has its own standardization method which is not necessarily the same as the XBRL standardization practice. And later on in one of our example, I'm going to show you because of the difference in the standardization practice, it actually leads to the data discrepancies between the two data sources. So let me go back to my slides here. Okay, so now I have introduced the XBL data as well as its structure. For now, the next task for us is to construct a CompuStat-like database, but using the XBRL data. So if we want to systematically compare the CompuStat with the SBL data, then for each CompuStat variable, we have to construct a counterpart using the SBL data. In other words, we need to map the CompuStat variable with the XBRL tag. The tricky part is because of the XBRL provides more disaggregated data so that there are hundreds, if not thousands of the tags out there, and the choice of tags is really up to the filers. The filer can choose to use a certain set of the tags, but not using other set of the tags. The choice of the tags are also different among the filers. But if we want to do the mapping between the CompuStat and the XBL data, we need to have a non-missing value for almost all of the tags. So to do so, we have adopted a bottom-up approach. We start from the tag at the most disaggregated level. If the filer does not use a parent tag, therefore there's no value associated with that parent tag, then we are going to add up the value of its immediate child tag and impute the value for that parent tag using that add up the value. And then we can just keep moving up our levels and do the iterative calculations until we reach to the data at the more aggregate level. So this is a very abstract way to describe our method. Why don't we use the example here to demonstrate how this bottom-up approach works? So I use part of the reporting. I think Joshua has a question. So.
Yeah, if I remember correctly, the numbers, there are about 30% of tags which do not belong to the ASB taxonomy. Mm-hmm. So you really have an issue of classifying those as well, I think.
Yeah, that is an excellent question. I think Joshua really remind us about one constraint about XBL tag is on the XBL filings, not all of the tags companies use are standard tags provided by the FASB. The filers can create their own custom tag. This is one constraint about our bottom-up approach, which is heavily rely on the reporting taxonomy structure provided by the FASB. But in one of our additional tasks, we are able to incorporate the custom tags into our calculation of our operating accruals, because other than the reporting taxonomy provided by the FASB, the filer itself also needs to provide a set of the files to explain the calculation relations among the tags they have used on their XBL filings, which include both the standard tags and the custom tags. So using the information from the filer self-provided calculation relations, we are able to incorporate the custom tags into our studies. Actually, by incorporating the custom tags, our results still hold. But I'm going to discuss the custom tag influence later in the additional analysis. So why don't we just go through this bottom-up approach, because it kind of been the foundation to our studies. So in this example, we have the data are at 4 levels. Level 4 is the most disaggregate level. Level 1 is the most aggregate level. And if I'm able to map the CompuStat variable with a single XBL tag, I will put the name of the CompuStat variable in the parentheses. For example, the CompuStat variable IBC, the income before extraordinary item, can be mapped to the XBL tag profit loss. And here, for the tag XXX, XYY, and the XZZ, they refer to other tags, but at the same level, okay? So we first obtain the reported value from the XBL filings and link them with the corresponding tag. For example, the tag increase, decrease in operating assets has the value of the 500. but apparently the filer does not use all of the tag. In particular, the filer does not use 4 tags, so that we have 4 tags here without any values. So what we want to do with our bottom-up approach is trying to impute the values for those 4 tags. So we start from the level 4, the most disaggregated level. XXX has no value. Its parent has no value as well. In this case, we are going to assign 0 to the XXX. But if its parent has a value there, then we will just leave it there and do nothing. So first step, we process level 4. After we processing the level 4, we move 1 level up. At level 3, we have 2 tags that have no values because the filer does not use those 2 tags. Then we can just use the value of its immediate child tag and use the calculation relations defined by the FASB reporting taxonomy, and then impute the value for the parent tag. For example, if we want to impute the value for the increase, decrease in operating capital, we take the 500 minus 300 plus 0, we give up 200. We do the similar calculation to impute the value for this tag as well. And now we have 2 imputed values here. And then let's just keep moving up to the level 2. At level 2, we have another tag has no value reported. Again, we utilize the value of all immediate child tags, do the calculations, trying to impute the value for this tag. So the bottom-up approach would ensure us that we have missing values for almost all of the tags. So this is the key step for us to construct an Xbl database, which is comparable to the compute step. So this is the basic algorithm. So in the extended algorithm, we can incorporate the custom tag into the whole process. So now let us look at some tests. So we first examine whether operating accruals are different between the compute stat and Xbl data. And our analysis does not rely on the breaking down the operating accruals into its components. However, to demonstrate the data discrepancy, we still show the comparison result not only for the operating accruals, but also for its 6 components. And all variables in these tables are scaled by the total assets. The result here shows that operating accruals, along with most of its components, have significantly different values between compute stat and Xbl data. So the next question is where the difference is from. We conjecture that it is mainly from the standardizations compute stat makes when they process accounting data. The basic rationale behind the standardizations is the compute stat would like to increase the comparability for the data so that the data becomes more comparable across firms or for the same firms across different periods. Increase in data comparability is good to researchers in some extent, but the firm-specific information is also lost in this process. More importantly, how compute stat standardize the data remains a black box to a lot of us. Next, we are going to use another example to show where the data discrepancy coming from. The table here is extracted from the statement of the cash flows on DSP Group 10K filings. And we want to use this example to demonstrate why compute stat accruals is different from Xbl accruals. As we could see from this table, out of the 6 components of the operating accrual, 3 of them have different values between the compute stat and Xbl data. The Xbl data is calculated according to the authoritative FASB reporting taxonomy. So one reason, as Ayong pointed out previously, why there's a discrepancy is the way the compute stat standardized the data is different from the FASB reporting taxonomy. For example, compute stat does not consider the line item change in trade receivables as part of the RECCH. This is the compute stat variable, which refers to increase, decrease in receivables. Instead, compute stat considers this line item as part of the AOLOCH. This is another compute stat variable standing for the increase, decrease in other assets and liabilities. Of course, in this example, if it is just the difference in the standardization practice, then it will not result in the difference operating accrues. It's just like we have a lot of the moving parts. We can either move it to here or move to there, but the aggregate number can still remain the same, even the classification method is different. However, if computes that omit a certain line item in their standardization practice, then it will surely lead to the difference in operating accrues between the two data sources. For example, here, the computes that omit the line item change in deferred income taxes and liabilities in the calculation of the operating accrues, but according to the FASB reporting taxonomy, this line item should be considered as part of the variable AOLOCH. This line item has the value of 2.833, which is exactly the difference between operating accrues from the compute step and the operating accrues from the XBL data. So we document the data discrepancy between the compute step and XBL data. Now what? Does it lead to the difference in accrues anomaly? Not necessarily. So the standard test to examine the accrues anomaly require us to rank the observations into the different portfolios based on the magnitude of the operating accrues. In the perfect world, as long as the ranking scheme remains unchanged, which means the same 20% of the observation goes to the, say, the bottom quintile, the same 20% of the observation goes to the top quintile. By the way, whether we classify observations into quintile or deciles doesn't affect our results in our study. As long as the ranking scheme stays unchanged, then the inference about the existence and the magnitude of accrues anomaly should be the same regardless of the data source. But in reality, the compute set ranking scheme does not always agree with the S-file ranking scheme. In our sample, about 32% of the observations have different quintile rankings between compute set and the S-file data. The ranking difference will lead to the difference about the accrues anomaly. So to test the accrues anomaly using the portfolio analysis is fairly standard. So at the end of the June of each year, we are going to categorize the stocks into quintiles or deciles. The results still remain the same. We calculate the monthly or value-weighted returns for each portfolio return from the July of the current year to the June of next year, and the portfolio get rebalanced. And then we form the hedging portfolio by taking a long position in the bottom accrues quintile and the short position in the top accrues quintile. Here's the result look like. We are not able to document any accrues anomaly, regardless of the return measures we used, whether it is the market adjusted return or abnormal returns based on various pharma French factor models. There's no accrues anomaly using the compute set data, but the accrues anomaly is still alive using Xbl data. The difference in the hedge returns is also very significant. So I see a hand from Ayun.
Hi, Daniel. I think I really like your DSP example. I didn't kind of read it as carefully, but this time when I look at it, I think you addressed my earlier question about how this new database classifies line items differently from CompuStat. One thing though that in the tables, I feel like as a reader, I would like to see is in addition to kind of reporting those kind of differences based on the CompuStat line items, can you give us kind of a top 5 or 10 more disaggregated or misclassified line items that can explain the vast majority of the discrepancy? So the anecdotal examples you gave us regarding DSP, can you give us some descriptive about across all the observations, what are the top 5 line items that is misclassified by CompuStat? So whether we can have one example that's deferred income tax as a representative of the population, or maybe other things are driving it. Yeah.
It will be a very, very challenging task to do that. We may need to think about how to do it because, like, again, different companies using different line items. They even name those line items differently. From the XBL tax perspective, they may choose their own, the different set of XBL tax. But I think this is a good suggestion, but we still need to think about how to do it systematically. For now, the way we do it now is we look at our sample and pick up the observations with the largest discrepancy and trying to figure out why there's a discrepancy. But we would definitely think about how to do it systematically. And I think it would be nice to provide the researchers with some statistics, like in which area, like more likely to have such a large data discrepancy. So
yeah, the motivation for the question, a quick follow-up is kind of related to last week's kind of Bob's table 3 and what Jiang was talking about is that if I'm studying, I'm a text researcher and I use CompuStat, I would really worry about continuing using that data set compared to another line items. If you can give me some descriptive on, top 5 items misclassified, ambiguously or unambiguously by CompuStat. Yeah, thank you.
Thank you, Adam. Oh, Jeremiah.
Yeah, I just have, well, I mean, first, let me say I agree. I like your interpretation. I think this is interesting. So coming from the reviewer side and comments and things that I've seen recently, there are other samples and measures you can use that make accruals work or the accrual anomaly work. And you did a couple in the paper, right? But people often give the explanation to those to say, well, if you do a certain sample of companies, so small stocks, for example, then the accrual anomaly will show up. If you use a different set of data, then the accrual anomaly will show up. And the two sort of explanations that I hear a lot are you've identified companies where it's really costly to trade, right? So that would be one possible explanation for what you're doing, that somehow the difference between CompuStat and as filed is related to the costliness of trading in these companies. And then the other would be, this is all spurious. And so you've done some great data mining that identifies another set of, carefully data mined patterns in the data. I'm not saying I think either of those are happening, but I think it would be nice if you could find ways to address those alternative explanations.
Yeah, thank you, Jeremiah. I think you make a valid point, but like in terms of whether it is that the small stocks or the stocks have like just a higher transaction cost that drive our result, I don't think that is the case. At least in our portfolio analysis, we use the value-weighted returns, so we are not relying on the small stocks. Actually, our sample does not concentrate on these small stocks, but the firm size sometimes do cause a lot of trouble because I can show you one table here. Usually, it is the small stocks that are more likely to have the large data discrepancies. So that is definitely one thing we can think about it. Another thing is I don't think like the difference in the accruals anomaly is spurious, because even though we break down our sample year after year, like basically from 2012 to 2018, basically for almost all of the years, we can observe a significant difference in the accruals anomaly. It is not driven by a small set of the stock. It's definitely not driven by a single year. But we will definitely need to think about how to address this concerns. I think
just a side point that's what Sloan showed before, right? And people still said it's spurious. So I mean, I'm agreeing with you. I'm just saying, what can you do to convince those sorts of people? I think is a publication challenge that I'm not sure how, I don't know what the barrier is to say that you've convinced enough people. You've convinced me, but I don't know who else to convince, right?
Thank you, Gemma. Frank?
One test that I would suggest you to do is to use a sample of Russell 3000 as your universe and report the results, especially when you want to speak to hedge funds and institutional investors who are likely to use the new data, right? I mean, retail investors are not going to download the data and run the question there, right? And institutional investors typically use Russell 3000 as their investable universe. So you do a robustness check using this alternative sample to see how big the results would be.
Okay, thank you, Frank. Joshua?
So something else that I think you should bear in mind is that CompuStat not only standardizes, but it takes time until it publishes its data in the CompuStat database. I.e., let's say a company files its 10K sometimes in February or March. CompuStat doesn't take immediately the data and puts it into the database. It does it in batches. It starts with the S&P 500 first and goes onwards. And smaller companies may end up with the data only in July or even afterwards. Whereas the XBRL data are available immediately for consumption. So that may also explain some of your differences in results.
Yeah, thank you, Joshua. We are aware of this timing issue in our studies. Actually, let me see whether I have. So this is just a regression analysis. So we are aware there are some timing issues. So that in one of our additional tests, we use say the unrestated version of the CompuStat, or like it is more point in time type of the CompuStat, so that we make sure we want to compare the apple with apple, orange with orange. But I would say our result is still there. But again, timing difference can be considered as one of the XBL data advantage, because again, XBL data is more timely. But thank you for your reminding, Joshua. Okay, given we are okay, we only have a little bit longer than 10 minutes. So let us quickly go through some tests. We find a similar result in the Furman-Macbeth regression after we control for other well-known return predictor. The coefficient of the S-filed accrues is significantly negative, but the coefficient of CompuStat accrues is positive. Sometimes it even becomes significantly positive. So the next set of analysis is we want to examine whether and how institutional investors use the Xbl data in tradings. We first examine what type of institutional investors download and view XBL filings. So here is this is really explorative nature analysis, and this is the regression result. We find that large and mature institutional investors are more likely to download XBL filings. Investors who actively manage their portfolios and whose portfolios have better performance in the past, the previous winners. And the investors who have a larger market impact, they are the ones who are more likely to download and view the XBL filings from the Edgar database. Given the characteristic we find in the previous analysis, in the next set of analysis, we focus on hedge fund investors, because if there is one type of investors who are going to utilize the XBL filings, we think it should be the hedge fund. And we use the change in the portfolio holdings to infer their trading decisions. We are interested in knowing first whether there's any association between the hedge fund's trade and Xbl operating accrues. And secondly, whether such association is moderated by the XBL filing viewing activity. In other words, we want to examine whether hedge funds are more likely to trade according to Xbl operating accrues after they view the XBL filings. In terms of the coefficients of interest in the regression, the beta here, we expect it to be significantly negative. Here is the result. We indeed find a significant association between the hedge fund's trade and Xbl operating accrues. However, in column 1, we fail to document a significant moderating effect of hedge funds viewing XBL filings. So we take one step further by decomposing the Xbl accrues into two parts. The first part is where just the CompuStat accrue is the same as the Xbl accrue. No new information learned from the Xbl filings. The second part is where the operating accrues disagree with each other between the CompuStat and Xbl. That is where the discrepancy coming from. And then we rerun our analysis after we do the decomposition. The result in column 2 suggests that the coefficient of the interaction term only significant when it comes to the difference part, the disagreement part. And we tentatively interpreted our result here as this: viewing Xbl filings indeed facilitate hedge funds operating accrues-based trade, especially when Xbl accrues are different from the CompuStat accrues, when the hedge funds can learn some new information by looking into the Xbl filings. And finally, we have done a bunch of additional tests to make sure our findings are robust. First, we would like to discuss a little bit about Xbl data quality. For now, SEC do not require auditing or any third-party verifications on Xbl filings. Therefore, it is inevitable that Xbl filings has some errors. And there are two major Xbl data quality issues. The first one is, I think as Joshua pointed out earlier, firms may opt to use the custom tags in their filings if they feel the FASB defined standard tags cannot accurately reflect their business practice. And the bottom-up approach, the basic algorithm of the bottom-up approach cannot pick up the custom tags, since the basic algorithm is heavily rely on the FASB reporting taxonomy. And the second quality issue is about the filing errors. To make sure our findings are not driven by the data quality concerns, we first calculate an alternative Xbl operating accrues after we identify and incorporate the custom tags into the calculation of the operating accrues. And secondly, with the help of the Xbl US, we exclude observations from our sample if any Xbl tags that we use to calculate the operating accrues are subject to any errors. And I'd like to spend a few more words about how to identify the erroneous tag. As I just mentioned, we receive a lot of help from Xbl US on this end. Xbl US is a not-for-profit organization. They have compiled different sets of the data rules to check every Xbl filings against those rules, and an error message or error assertions will be popped up if any of those rules got violated. And basically, we retrieve all of the error messages from the Xbl US and parse out the erroneous tag from those messages and determine whether that erroneous tag has anything to do with the operating accrues. So this is an example of the error message generated from the Xbl US. And in this example, it is this tag, entity common stock shares outstanding, is considered as the erroneous tag. There are millions of the error messages out there from the Xbl US. So as you can see from this table, our results are quite robust after we incorporate custom tags into the calculations and after we exclude any Xbl filings with any type of the errors. And the last test I'd like to discuss is about the generalizability of our accrues anomalies findings. We examine whether the difference in the predictability between Xbl data and the CompuStat data also exists in other accounting variables. So out of the 19 accounting variables we examine, we find 4 more accounting variables of which the stock return predictability also varies depending on the data we use. Okay, Steve, you want to add something?
Wow, Daniel, you're fast. I was hoping that we'd have an opportunity to say this just at the end. I wanted to save a little time to talk about how I thought this was related to the theme of this series of papers, which is the accounting design project. And so, I mean, this does change the way in which investors can access financial information. And think about Joshua Livnat's comment about how XBRL data are available basically the second the filing hits the SEC website, whereas CompuStat data is significantly delayed by the standardization of the process that CompuStat goes through. That's rapidly accelerating the availability of financial information. And I also think it's interesting to think about this structured data filing format, which is now fairly mature in financial reporting, and the way it's expanding to other kinds of data that researchers can use. So ESG reporting is under consideration for formatting in an XBRL-like dialect. Companies, diversity enhancement and inclusion initiatives are also currently subject to SEC proposals that would perhaps see them written in this format. The Federal Energy Regulatory Commission is moving to XBRL formatting of its filings. And so this is not only, I think, a big deal in financial reporting, but it's a big deal in reporting on many different regulatory matters in the United States and abroad. Sorry, Daniel, I didn't mean to step on you there. I just wanted to make sure that point got out before we concluded.
Yeah, thank you, Steve. I think it just makes my job when I talk about the implication of our paper much easier. Thank you, Steve. John, you have a question?
More just a comment. First, I like the paper. I congratulate you on doing it. I think if I go kind of back up to the top of the ocean, maybe thinking back to what Dan was talking about initially, I think market efficiency to me has at least sort of three dimensions. There's the data dimension, there's the analysis technology dimension, and there's the trading cost dimension. And so it may be useful for you to think about, where in the grid of data, crude all the way to ultra refined analysis, simple quintiles all the way to lasso technologies, and trading costs high all the way down to very, very small. What your study and maybe things that connect to what Steve was saying going forward in the design of accounting information say about what we can and cannot infer as to where the market is in terms of its current efficiency and where it may have been in the past and where it may go to in the future. So maybe at the end of the day, pull back up to make a point that connects back to Dan as to what in the end do you say about this very crucial issue of market efficiency? What do we mean by it? How does it connect to data, analysis technology, and trading costs, at least, and there may be other dimensions?
Thank you, John. It's very, very, very helpful comments. So we indeed face some questions about how our paper speaks to the market efficiency in the reviewing process. I think your suggestions is very helpful and very useful for us to address those concerns and comments. Thank you, John. Stephen?
I didn't quite understand the timing point. If I'm a trader, I can sit and wait till Combistat puts it out and I'm late, okay? But I can also, as soon as the 10K or 10Q hits the, I can go to that and I can use the information there without the XBRL. So a comparison for trading of just using what I pick up without XBRL relative to what I pick up with XBRL, I think that for a trader, I think that would be the appropriate comparison, not to Combistat.
Yes, yeah, I think you are definitely right. But because the starting point of the paper is trying to figure out what is the research inference that we can draw in terms of the data discrepancy. So we go with the Combistat at the first place, especially the version of the Combistat that researchers have the most access to. We know, from the trader's perspective, they have a whole different animal. They have a different version of the Combistat.
No, I understand. I understand from the research point of view. As we said last week, we were a bit lazy using Combistat rather than going and dragging the thousands from the 10K. Of course, up to recently, we couldn't drag it out from the 10K, but we can now. But the question is whether now I want to dig further into XBRL or just take what I take from the financial statements as reported in the 10K.
I think for the 10K filing, there's an issue is about whether it is human readable or it is the machine readable. 10K filing itself is more human readable. It is the HTML filings, but if you want to say grab the filings from the universe of the stock market, and you want to quickly put them into the computer to do the analysis, I think the XBL filing, which is machine readable, will provide the people with some advantage because it's more readily available for the say the software processing. But maybe I'm just I'm not that good at the.
Yeah, I understand that, but for an oldie researcher like me who has to learn up this SBRL, and do I have to learn Python? I don't know. But there are other technologies pulling the data down without having to really understand fully the XBRL technology. Mm-hmm. Maybe I'm just indicating I'm too lazy at this point.
No, you are not. I mean, it is indeed to give us some troubles to process the data. So why don't I just go to the very last yes, slide?
You can conclude. We're out of time. Thank you, Daniel.
Yeah, I'm more than happy to have this like other discussions. Okay, so this is pretty much we have done is the study. So overall, we find that the difference between Xbl data and the CompuStat data, the researcher version of the CompuStat data, is large enough to affect the research inference. So as a researcher, we have to be cautious about the data difference. We also find for the practitioner, the investors, the Xbl data could provide them with some trading advantages. And given the usefulness of the Xbl data from the regulator's perspective, they should think about how to increase the Xbl data reliability and the usability. Like Stephen just pointed out, it may not be easy to process the Xbl data. And we think more XBL studies are definitely needed to just deepen our understandings. Without showing the big thank you, so a reminding about the upcoming accounting design project event on next Thursday. We are going to have another 2 excellent workshops about the evaluation of the intangible capital. Please just stay in tune to the ADP project. Okay, with that being said, a big thank you from Canada. Thank you very much.
Thank you.
Thank you very much, Daniel. And just a reminder that the starting time next week is a little bit early. It's half an hour early because there are 2 papers. Thanks again to Ayun and Stephen, and thank you everybody for your active participation. Have a good afternoon.
Okay, I will stay here maybe for 5 or more minutes just in case there's some other discussions.